Welcome everyone. Good morning to everyone, and good afternoon and evening, depending on when you are, where you are connecting from. I'm Giuseppe Basile, also known as the FibStalker, and today I'm going to talk about improvements to the continuation style method. This presentation is part of a series I'm running on FX Street, and you can review the previous presentation and webinars of the series as well. The continuation style method is a breakout method, and I'm going to talk today about ways to improve the risk, reward to risk, as well as manage false breakouts. Okay, so where are we in the course? I made a little change, so I anticipated the systems improvements, which is this published research I made back in 2012. But before we get into that, I'm going to review 8 markets, and those are the markets I trade using the intraday system. I want to thank Vicky and Adinda for setting up this presentation. As you know, risk is trader's job number 1. That's my main belief. And I'm going to present charts. There is reasoning behind them. I want to have time to present all of that. So whenever you take decision, make sure that you manage risk properly. If you are watching this presentation now, please stop it and read the disclaimer here. I'm not going to talk about myself. I've introduced myself at the very beginning of this series. I have a number of webinars on FX Street. I'll only say that this year, the end of 2015, I will complete 19,000 hours of total market exposure, and I'm into analyzing the effects of algorithms of price, okay, in modern market and especially high volume market. So this is the model I always have in mind and as a reference. And by the way, I'll answer all the questions. If you have any questions, please write them down, and I'll answer them. I like interactive sessions, although my sessions are always very packed with information. So sometimes it's difficult to give enough time to questions, but interrupt me during the presentation as well. I'm gonna answer. So there are 3 main areas when it comes to mastering trading. One is the mechanics of trading, and that's the first box here in the bottom. Risk management, money management, the trading method and timing. Believe it or not, this is only 15% of trading. In order to consistently apply methods, timings, and all the techniques that you use in trading to reach profitability, my belief is that you have to formalize your rules in a trading system, and then use that for testing, paper trading, and actual trading. That allows you to build confidence and trading and tune the trading system. But it doesn't end there. This gives you the possibility to get into profitability. And here, as you can see in this model, what I call the model of profitability and consistency in trading, getting to profitability, it's a sequence of solving problems. And these problems are generated by observation that we do in price. So an observation actually solves a problem, which brings us to the next one and the next one, and so on until we eventually reach profitability. But that doesn't end there. The most important area deals with ourselves, our beliefs, and expectation objectives, and how we use game theory and calculate our statistics in order to improve our the way we apply the method and so reach consistency. So it's a little model that I always like to remind here. So far we covered the 7 lessons here. I made a little inversion. I want to talk about system improvements first. This is a research I published in 2012. So before I get into that, let's have a look at the market. Let me switch on the trading platform, and for charting I use TradeStation. If you have any questions on this market, let me know. So here, I'm going to review 8 markets, starting from the euro versus the Canadian dollar here. So this market has benefited from the move we saw, the huge move we saw 1 week ago on the euro, and it went into a sequence of measure move, which we can see very, very clearly on the 4-hour time frame. Market responding to 148.40 and then moving into the first and to the pip, which is beautiful, second target. So the sequence here has failed, and that's the reason why we saw this market starting the correction lower here. And of course, very, very technical market, and it is anticipating a continuation lower, at least into this 148.76 and then 147 potentially. The point is, we don't know how this is going to change with 2 days FOMC. Okay, so the euro dollar, same thing here. Actually, we have an opposing short, the area starting from 110.18, and as you can see, there was a response 3 times, even 4 times here. So where this market is going, very, very clear, very technical market, high volume market. So we had a participation here at 108.09, which broke price right into that first target, profit taking. So if this market is continuing higher, which means that we would have an event which is bearish for the euro dollar today, this market should actually come back to 108.49 and then continue higher to break 111. Now, if it breaks 107.99, on the other hand, the move lower is likely to be resumed here. Okay, moving to US dollars and Japanese yen, of course, this market moves opposite the euro. A lot of people that are invoking a top in this market. I see no top in this market, and you can review also my study on the US dollar Japanese yen and actually the Japanese economy in August 2014 on FX Street. And what we have seen recently, so when we look at the daily in this, when we look at the daily for this market, actually let me show, let me switch here to the daily time frame. Now, when we look at the daily time frame of the US dollars Japanese yen, there is nothing such as a top here, because the market is respecting the next measure move higher, 117, 118 here. So some people are looking at this double top here and they're invoking for potential top in US versus Japanese yen. My opinion, no top at all. We are actually continuing potentially higher, and recently this market has seen a measured move here, which broke price into the first target, although it was busted. And then, it came recently very, very close to trade that measured move there. And indeed, it actually traded this area here, the 120.90. Okay. Now, I think this market has to retest the 119 or 120 here eventually to have a strong continuation higher, but there is no such a thing as a topped US Japanese yen here. Moving to the Australian dollar versus New Zealand dollar, this market has been moving laterally beautifully, and with between these wedge here. I don't trade trend lines. I only use trend lines to identify market conditions. So this is a market that is moving laterally at the moment, and there is the possibility for this market to move all the way into a retracement, a full retracement of this move lower here, and that would be 108.47. So at the moment, this market is moving higher, it's not moving lower any longer, in my opinion. US dollar versus Canadian dollar, beautiful, technical, strong market here. And when we go back, when you go back to last December the 8th, I also showed this continuation move here in this market. It was a move higher. The consolidation that we saw here, we also used this symmetrical triangle to model the continuation higher here. Of course, that's one way you can model these markets. I also use the effects of algorithms on this market. So now when we go back and look at the Canadian dollar and on the weekly and daily time frame, we know very well where this market is going. It's very, very close to its target, to its long-term target. And actually, this is something you can identify on the weekly time frame as well. This is an extension that has traded in April this year. And as you can see, excuse me, you have to take a very, very long term view here in these markets. 132 was reached back in August, and now we are reaching the second target. So there is not a lot of potential, continued higher potential higher in this market. Eventually, this market will retrace, and we are very close to that second target. And eventually, this market has the potential to retrace into 133.25. Believe it or not. Okay, so this market is in the late stage on the daily and weekly of a move higher, and I believe we're going to see eventually a retrace. Now, on the 4-hour time frame, again, there was a beautiful sequence of measured move here, which you can trade with a very small risk when you apply FibStalker timing here. Price responded at 135.28, retested it beautifully. Responded in this area, they retested it, and then when you the first and second target, and again, then we traded the next measure move here. Very technical market, right? And so it was here after the second target here. Market went into this area, retested it, respected it, moving higher. Okay, however, it's moving higher on the 4-hour time frames, but on the daily, it's very, very close to that long-term target. Okay, so euro, Australian dollar here, we had the this market actually responding to first measured move here, price into the first and second target. The next measured move failed, and that's the reason why we saw failed, and then the market went back to failure here, back to the previous high, started a correction lower. So this market is anticipating a weakness compared to of the euro compared to the Australian dollar, okay, which would actually match continued strength in the dollar. To have continued strength in the dollar, we have to have the start of tightening. So if this market goes, it continues down, we're gonna see 148.61. Okay. Next, of course, Australian dollar, US dollars, a very technical market as well. All these high volume market, very, very technical. And what we have seen here recently, we've seen this market coming to retest the old halfway back 72 once, twice, 3 times, 4 times, 5 times area respected. So this is anticipating lower US dollar, which would mean not tightening in this specific case. So as you can see, the different instruments are actually telling different stories at the moment. Okay, and I'm spending a little bit more time on what I had initially planned on the review of this market. I believe is very important today. Generally, is important for you if you wanna get an idea where this market are going in the short term as well as the long term. This market has been very technical as well, and traded into the first target there, and then the next measure move failed, and we saw this market. We failed the next measure move, and this market is actually coming into all the way halfway back. So when you know this kind of information, it's easy also to set up trades with very, very, very low risk here. As you can see, there was participation at this level. All right, so this market is anticipating weakness in the Japanese yen and so strength in the euro. Sorry, a weakness in the euro. And that's it for the review. If you have any questions, you let me know and I'll answer them. Let me get into the content, back into the content here after our market review. In my market review, I used the FibStalker methods, which is the methods that I use in my own trading. So let's look at the content here. A typical problem to be addressed when we look at the continuation style, and I mentioned that in the first two lessons, is the risk of false breakouts. So how do we manage them? There's not a lot we can anticipate in relation to when or why or if a breakout will retrace. The only information we have are market statistics, and in the second webinar of this series, I spoke about a little bit more about these market statistics. These market statistics are aggregated. I also there is much more information when you look at the patternsite.com as well as the encyclopedia of chart patterns. Some of the estimates are mine, come from my experience, and I definitely recommend you to again have a look at the November 18 webinar, because that's where I touch a little bit more in detail on these statistics. So the only thing that we really have are statistics. Of course, statistics alone are not enough because we need practical help, right? We need to know what to do, when, and exactly what to do in order to manage risk as well. And risk is always trader's job number one. Is there anything we can do in order to limit the effects of false breakout breakdown? Of course there is. So let's look into some ideas here. And this is the research that I presented at the TraderFest in 2012. That is the second largest trading event in Italy. And that's a picture of mine when I was a little bit younger there. So the solution is based on this research. And I will often reference this research as well. Now, we need, and we are looking at a multi-timeframe method. If you think about it, what we saw about the continuation style so far, we presented a method which uses multi-timeframe information, and we want to augment that. Now, of course, the continuation style is not new. It's not absolutely innovative. And in literature, there are a lot of multi-timeframe methods that you can use, and they couple different techniques together. So, for example, example of multi-methods timeframe systems can be the Alexander Elder's triple screen. If you know that, Brian Shannon's, he has a very good tech analysis, pure tech analysis based method using multiple time frames. He uses averages, so of course there is a lagging effect there. And Martin J. Pring, the No Sure Thing, KTS indicator, if you ever heard about it. Actually, I was recently invited to for a speech at the National Canadian annual conference of the Canadian Association of Tech Analysts, and Martin Pring was connected from the States, and he talked about, of course, his indicators, an introduction, but also gave a view on the market. Is pretty, it's pretty bearish about the market. I mean, he has a bearish bias at the moment. Now, these methods use combination of time frames, weekly, daily, down to the 15 to 10 minutes as well. They use standard and custom indicators as well as divergences. So let's look at some of the briefly of the method here. Trend following on higher time frames for trend identification, counter trend methods for filtering on lower time frames, for example, Brian Shannon. Divergences between indicators and price, examples are MACD, Force Index for Elder, moving average, trend identification, breakout from continuation price formations for timing, and we use that as well as our timing mechanism in the continuation style. There can be derived indicators like the no-sure thing, Martin Prince no-sure thing, which is derived from the application of the ROC, rate of change, on each of the main trends, primary, secondary, and short term. And then trend line breakouts for those who believe in this. Now, in this little table here, I've summarized for you, the points of strength and weaknesses of those TA techniques that I just mentioned. So we have trend following, moving average, divergences, breakout, indicators, and trend lines. This is a very simple but very, very useful table that tells you, what are the strengths and the weaknesses, and actually, we want to look at the strengths, of course, and we want something like trend following, which is simple, but it has a lot of weaknesses though. Delayed, frequent losses, dependent on market conditions. For example, if the market is trending, of course, a trend following system does well. When the market goes laterally, not very well. Moving averages, they're very simple, largely used, which is not necessarily an advantage. Okay, if something is largely used and everybody looks at it, and 95% of people lose money in the market, we have to be very, very careful in assessing how a method can be of help. 30% value added sometimes can be used, especially on larger time frames, but also smaller ones as support and resistance, and allow us also to identify targets, because when you have a 50% or 20% moving average on a large time frame, you know that when the market gets into that level, there'll be some sort of profit taking or some sort of participation. The weaknesses are delay, and I believe it's very, very relevant. I mean, moving average is a trend following indicator. How can it help us identify level where price reacts? Let me bring you back to my charts here. Let's look at the last one here. Tell me how a moving average can actually help us to identify this level 86 in this market, Australian dollars, Japanese yen, where the market abruptly reverses. Okay, so there is no edge. When we want to look at this kind of market price behavior, which is there, it's consistent. You observe this price behavior consistently. There's no way a moving average can help us with that. Okay. Now, divergences, counter trend. It's a lot of people like them because they allow us to actually get into a trend early, especially a counter trend. Well, only a counter trend. It's not reliable though. I've been studying divergences for years, and breakouts can be intuitive, work well with stocks, well-defined risk, lots of opportunities. You can find lots of opportunities in all markets, including Forex, stocks, futures. However, there is this pattern of false breakouts, which is exactly the problem that we want to try to address here. Indicators, direct, they are very, visual. They can be objective. If you study all the cases, they can present, but they are derived by price. So we should ask why we would want to trade something which is derived by price and not trade price itself. Have you seen any indicators on my charts? No, that are known. So delay, time gap, no entry price level. If you think about it, an indicator does not give you a trading plan. just gives you a point in time where you should get involved, probably in one direction or the other, but you don't have a stop, you don't have profit. An indicator does not tell anything about how you should structure your trading plan. Only price does. And so no stops and targets. And trend lines, finally, simple. Doubts on traceability, you can trace them in a number of ways. And but again, that problem of false breakouts. Now, before I get into more details here, I want to remind you of two important definitions here: reliability and expectancy. There are ways to measure your edge, and actually, and you know, I don't want to be mean here, but a lot of trader I told to, they believe they have a method that's just doing discretionary trading. That they don't know exactly where they are trading. And I don't mean to be offensive here, but this happens very, very, very frequently. So what is reliability? It's a percentage of trades close with a gain. So, for example, if you have a failure of 30%, your reliability is 70%, of course. Most importantly, the expectancy, or mathematical expectancy. And this is the gain, which is expressed in dollar, corresponding to the unit expressed in dollar that is risked. And the beauty of this measure is that you can apply to, you can take 30 trades you had recently and apply this measure to your trades. And this should give you an indication of how effective is your method. In fact, if you have, for example, an expectancy of 0.3, it means that for every dollar you risk, you gain in average 30 cents for each trade. And this includes the losers as well. So this is a very important measure, and it's very important that you keep this in mind when you're trading. If you don't know these numbers, stop trading right away. Okay. So so we spoke about the continuation style, and if you have not, although this presentation is quite general, if you have not reviewed the last few lessons, please do. All the method is based on a move, which can be higher or lower. There is a consolidation, and then a breakout. In Italian, consolidation is consolidamento, and then there is a breakout, and we basically set the target at the equal move here. Okay, and now you can take the equal move from the low, or you can take sometimes the equal move from the breakout level. I prefer the low, is more conservative. So we looked at the statistics, and in average, the breakout has a very good reliability overall, considering all the breakouts, all the possible consolidation you can have here. Hits the target, quite frequently, 60% of the time, with an expectancy of 0.37. And we looked at this as some of these consolidation patterns. Particularly, we looked at the CP continuation pattern, the triangles, and the bases and flags. Okay, so I'm not going to get into this, of course. Now, just some definition here. Consolidation, you know that the breakout or breakdown, in this case, is a long, so it's a breakout. It's when market gets above the high of the pattern that identifies the consolidation. In this case, the pattern is an ascending triangle. And of course, there can be a throwback, and that's one of the problems we have to look at when the market breaks and then throwbacks. Now, it's going to fail or it's going to continue higher, right? This is a successful consolidation here with a successful breakout, and there can be a failure as well, whereas the market comes back and then continues lower. Now, we want to study ways to protect us from this or help us in managing these kind of situations. Now, when the market when the market behaves like this, these are the definitions and the statistics. We have seen those already. Again, these are aggregated statistics. I gave you the sources already. If you wanna know more about each of these cases and study those in more detail, the material on the patternsite.com, it's very, very useful and it's great material. So we also looked at how to connect formations. So for example, we have on the daily time frame here, we have CP, a continuation pattern. When we break it down on the 15 minutes, we get this beautiful base here. You can see it as a base. You can see it as an ascending triangle here. But the main idea of it is that now, thanks to this consolidation and the way it actually forms on the 15 minutes, we can actually reduce risk from this level or this level to a very much smaller level. So it's also very easy to get a free risk trade. You will remember a free risk trade is very, very important. If you don't know the concept of free risk trade, please review the previous two previous presentation, and particularly the previous one, part four, because that is a concept that you have to absolutely integrate in your own trading. So multiple time frames and give us the possibility for a better trading plan. I have touched on this in the previous parts as well, when I talked about the different patterns that we use and how we connect them in the same time frames or in multiple time frames. And when you put all the information together, starting from the daily and weekly, so the higher time frame, whereas you can also see the positioning of the SMAs, and then you actually combine that information with what's going on the smaller time frames and actually the patterns that you see on the smaller time frames, as well as the indication of volume that has always to support consolidation here. As we can see, in case of stocks, when we have that information, we have to use that information. So when we combine all this information together, we also know what's the room available for the trade. We know we can manage risk and reduce risk, and so we can obtain a free risk trade much more quickly. So what are the parts of the trading plan or the trading system that we are attempting to improve? They're the same of last time: entry, protective stop, and position sizing, because we want to reduce risk, which means readjust entry and especially stop in order to give our trade more chances to survival, as well as reach a risk-free trade status as soon as possible. Okay, so these are some additional example of how we get that objective by looking at the move, then the consolidation, and then the next move, and then breaking down the consolidation with the inner pattern here. So in this case, we could actually even place our stop here. So we could go from a situation where we have $1.13 of risk per share to lower it to 0.91. If we were to select this level, probably our risk will be around $0.7 per share. So almost half, or 40% less than the starting point there. Okay. Third example, there is a descending triangle here on the daily chart, and then when we look at the smaller time frame here, we have the same formation and the same trend line that we see on the daily time frame, but now we can use levels on that line, which allows us to reduce greatly the risk here. We can use this level here, and we bring risk per share to 0.57 from 115, so half of it, and then even 30% of it. by actually using other levels on this trend line. Okay, when we get into this into the details of creating a trading plan for this opportunity. So again, the drop here, consolidation on the daily. We also have CP here, or kind of, and again, we can reduce. When we look at this, we can reduce and go from 0.21 to 0.15. So I'm not going to get into more details here. So the most important questions to ask is that how do we create reliability and expectancy with the method, and how then we improve them? So we use the continuation moves consolidation with low failure rate based on the known statistics that I showed you before. We use the power of setups identified in different time frames, and I showed you an example of that as well, going from daily and weekly down to 4 hour, 15 minutes, 60 minutes, and 15 minutes. Filter out setups with significant opposing resistance and supports, which is we can identify, for example, using resistance and support level given by moving averages on the higher time frames, and that limits the ability of price to move into a target. And always for us in the continuation style, the target is the equal move into the target that we saw, that matches the previous move that activates the pattern. So we have move higher, consolidation, and move higher. So this is the first move that activates the pattern, and it gives also a target, and the target is the equal move. Okay, it's the equal move. So of course, if you have moving averages before that kind of stop this market, or that do not give enough room for this market potentially to go above that level. Of course, the market could always do that. The market can do anything. The point is that there is a possibility for the market to do this. So in this case, you don't wanna take this trade. So we reduce risk also connecting price formation on the same and different time frames as we see. Now the question is, how can we further reduce risk and increase the reward to risk ratio using other methods, for example, the historical methods of FibStalking? That's just an idea. You can use others. The practice shows this is possible, and I'm not going to make an introduction of the Fibonacci retraces the way I use them in the FibStalker methods. I gave you an example before when we reviewed the our eight Forex markets. There are a few models. There are also presentations you can and webinars you can watch on FibStalker, in which I explained some of the models in detail. I also showed the use of these models in actual markets. So there are sequence of measure move, there are extensions, and there are failures of a trend. When a trend fails, that's important as well. So it's information that we have to gather as well. Again, if you want more information, you can watch the webinars, last year's webinars, and you get a lot of information about that. But let me explain you the timing, how the timing works very, very briefly here. Whenever we have a move and a consolidation, can you see here the pattern, the continuation style pattern is kind of embedded into the FibStalker methods in a way. Sometimes market retraces to the 50% level. When that happens, we don't just buy blindly the 50% level. We never do that. I never do that. What I want to see, and I'm going to show you an example on the SP500, very, very recent example on SP500. When the market approaches the level where we anticipate a participation from the larger time frame, can you see here? The market is correcting on the smaller time frame, is correcting down in a counter trend move in the smaller time frame, but the larger time frame we anticipate, and I say anticipate, not expect. We anticipate a participation on the upside. We need to get a confirmation for that. So how do we get that confirmation? You get the confirmation by studying the sequence of measure move as the market moves lower into that area, okay? And if the participation that is coming from the market is capable of breaking the sequence, and again, you can go back and look at these models here when the sequence is broken, then it means to me that the participation that is coming from the larger time frame is stronger than the participation that is pushing this price in a counter trend. So this tells a lot of what's going to happen here, okay? And it can be used, I consistently use it as an edge in my trading in order to predict whether the market is going to continue higher in a continuation of the trend or not, okay? So this is a nutshell the way I look at this, and this is basically the explanation of what I've just mentioned. Now, if you don't buy in C, but you buy in X, right? Your reward to risk, your pip risk is higher, right? Now you would think that this is a bad thing. It is not, because by applying this method here, you're also filtering. You're also filtering trades, which means that both your reliability and expectancy can go higher, although you have an higher pip risk. And this is again an illustration that you can apply this method on trends as well. And the participation that has to come from the larger time frame has to be capable of breaking the sequence of measure move as the market moves lower. Okay, now let's look at just a very recent example on the SP 500 E-mini here. And when I switch back to my platform here, charting platform, and I look at the application of the FibStalker methods here to the SP 500 E-mini future contract here. This is the March the continuous contract, and we are in the March contract. Those who follow me know that, and you can subscribe to the newsletter as well. I traded and predicted the bounce in this area here. You can go back and watch the webinars. And my weekly newsletter where I do an analysis of the markets every Sunday. So this level was known with few days in advance here. When the market came in, it bounced it. It was a very good trade. Now that happened again. So the market went for a second test of this 1992 here, 2000s level, and we can clearly see and apply the timing here. And when we look at the sequence from high to low here, participation at 257, we knew about this participation before price tested the area of potential support. The market went into the first target and second target, and then the next measure move failed. And that's exactly the application of the method, right? So when it fails, we know that there is enough participation that is breaking the back, so to speak, of the bears here, and the market is moving higher. So when we look at this chart, what this market is anticipating, if the market is going to continue higher, if we look at the patterns in the last few years, it means that more free money from Fed, quantitative easing is coming into the market. So what the SP 500 is anticipating to me is that today the Fed is not going to tighten up. Okay. Now, this doesn't mean that I know the future. This doesn't mean that the decision might be different and the market reacts differently. But algorithms have a tendency to, and clearly algorithms are placed long here in this market, as you can see here. You know, long, and so they're anticipating a continuation higher. So if I had to base this, if I had to interpret this with the information that we have, that's what we're looking for at this stage. Any questions so far? We are approaching the time, and I spent a lot of time on charts in this presentation. I'm glad I did. Any questions so far? See, there are a few participants there. So let me see if you have any questions. Please go ahead. And Carlos, Peter, Vicky, Dimitri. Hello, Vicky, and Zaya. So if not, I'll just continue here. And I'm not sure we'll be able to cover all the content. If that's the case, I'll do another second part on this, because this is very important. So just showed you the timing of this 2000s level here once again, and we could do that well before the fact, well before the market went into that level. And we knew when the market went into that level, how we could actually time that level as well. Okay, I showed you just showed you an example. Once the market went above that level here, the market continued higher. So this market is anticipating no tightening from Fed. Okay, we will see whether that's that's the case or not. So now, how do we use the FibStalker methods or the FibStalking timing in order to improve our entries? Well, if we know that there is a sequence, we can actually try to optimize our entry. How do we do that? Well, first of all, we have to identify our consolidation, and we can identify our consolidation also using the FibStalker methods. For example, highs to highs, there is a correction here, and then price getting in the first and second target, right? So this is a consolidation here. It's a consolidation I have identified not using the common method of price pattern. I could have done that by, for example, tracing a trend line here, right? This is the C point here, okay? But I've used the FibStalker methods to identify also the potential area of bouncing here, which is C. That's the blue line there. So what do? We actually analyze the sequence of measure move in the smaller time frame as well. And I use the 60-minute chart, maybe the 15-minute chart that have been clearer here. But if you follow the logic and the rules, there is a sequence of measure move here. It's A to let me change color here. It's A to B, which identifies C, and then brings price into D, and then C to D identifies E, very technical market. Of course, this is applied materials, which is very high volume market. So we get into the first and second target, and now, again, the market goes from C to F, identifies G, and we keep using traditional measure move here. Eventually, at I, the market fails. So that failure can be used as a potential level for entry. Now, the market retraces against us after the entry, but never below H, which is, the level here. So if we use the FibStalker method with a stop below the red line here, we have 0.15 dollars per share of risk. But if we study the sequence of measure move in the smaller time frame, look at what we have here. We brought that down a lot from 0.15 to 0.11, 40%. Okay, sorry, it's a little bit, it's not 40%, it's 30%. Okay, so that's the kind of idea in applying these methods here. Now, I had other examples, but I'm not gonna get into those. So, and I will leave you with this question here. So we will need to spend more time on this to show you the full result of the study. I will anticipate some of this. But the idea here, it's important to ask the questions. If you're able to ask the questions, we can find answers. So that's important. Trading method that explains price and trends and sequence of Fibonacci, traces, and failure. I showed you that. That's the FibStalker methods. That's my proprietary method I use to trade the markets. Near the setup area, we always wait for the counter trend move to fail. I showed an example of that as well on the SP 500 recently, actually 2 days ago. Rely on the objective observation that a trend remains intact until a stronger or opposite participation stops and inverts it. Exactly what I showed you in the SP 500 E-mini. In this way, we typically reduce the reward risk, but we filter out more losses. So both reliability and expectancy indeed increase. And if you look at charts, you will convince yourself that's exactly the case. So now the objective and the question is it possible to increase the ratio, the reward risk ratio in setups offered by the continuation style by using the FibStalker methods and the FibStalking timing within the consolidation area? Of course, it's a rhetoric question. The answer is yes, and there is a very good improvement in reliability and expectancy. Now, I actually planned the time accordingly. Now, Adinda, will you let me know if we have more time here, or I will need to close this presentation here? Because if I have, I can briefly show some of the results, and then I'll pick up in the next webinar. I'll pick up, and we will continue and conclude, and give you also the statistics and the the results of the study. Dinda, will you let me know here if you have questions? By in the meantime, please let me know. And let me see here. Usman, Carlos, Peter, Zia, any questions? Well, okay. I hope this was interesting. And okay. Now, so I will just continue as I don't hear from. I'll just continue, and then let me switch on the original material here, and I'll just anticipate some of the additional. So what I actually will need to show you as we continue here. This material is in Italian, but let me show you just don't mind about the language. Look at the charts, and what we're going to do. We're going to study the consolidation and the breakout. So what happens during the consolidation? And actually, when we do that, we can come out with a lot of scenarios of what can happen after the breakout. Okay, so and that's independent from the specific consolidation that we use. In this case, it's an ascending triangle. The market can come back, and it can, when it comes back, it can respect or not the sequence of measured moves. Okay, so basically we are blending now the consolidation and continuation style with the FibStalker method, and now there are a number of different potential scenarios that can happen, and when we study all these scenarios, we come up with all the possibilities, and I'm going to show you this in detail in the next presentation, where we study all these cases. And there are also cases in which the market respects a relevant level, the trend continuation area, but then also respects the opposing trend continuation area, and there is a failure. So in high volume market, these traces are pretty much are very much respected, and I will show the example in the next. Peter, I mean, I'll show you some examples in the in the future. Unfortunately, there is no time now, but I promise I'll do another presentation. I will present the result. In a nutshell, here, it's important to set the stops in a way that they respect the next area of participation. And so typically this will be the 61.8% level between the largest area of the consolidation. Okay, so just as a nutshell for now, get these rules. A to B, you put the stop not above the 61.8% level of this move. Okay, of the difference. So this is the, if you wish, this is the 38.2% of this distance here. Okay, and I will come back, and I have a lot of examples in which this is clearly shown here. For example, you had a triangle here, and the market respects it first, and then it comes to trade the trend continuation high. You put the stop below this level. Okay, so we will touch on this in more detail, and I'll give you the statistics as well. I have a lot of examples here. I have studied this in a lot of detail for several hundreds of stocks, and I'll anticipate here the results. So there is a 70% increase in expectancy when you use the rule, and a 28, almost 30% of increase in reliability. Okay, so I will get into this in the second part of this. We'll definitely need a second part. Okay, so don't be worried. I'll give you all the data and also in detail the rules to actually take advantage of this. Okay, so I hope this first part was interesting and useful. I hope also the review of the market is going to be useful, and let's see what happens today with the Fed decision on FOMC. Okay, so I hope you'll be there in the next webinar, and I'm going to answer all the questions. If you have any other questions, please send them in the by email. You can reach me at FibStalker at gmail.com. Okay, so we will continue with the second part. All right, so thanks for being here now, and I'll see you on in the continuation of this series. Okay, thank you very much, and have a great day. Bye bye now.